Have you ever wondered how to maximize your investments in a tax-efficient way? Welcome to the world of tax-efficient investing, a realm where understanding the tax implications of your investment decisions can make a significant impact on your returns. Tax-efficient investing is all about strategizing to minimize the amount of taxes you pay on your investment gains. It's not just about how much you earn, but how much you get to keep after taxes. The importance of tax efficiency in investing cannot be overstated. Without a tax-efficient strategy, you could be losing a significant portion of your returns to taxes. By understanding and applying tax-efficient strategies, you can keep more of your investment returns and build wealth more effectively. Whether you're a seasoned investor or just starting out, tax-efficient investing is a critical aspect of financial planning that can help you achieve your financial goals. So, buckle up and get ready to explore strategies that could help you keep more of your money. Before we dive into strategies, we need to understand the basics of how investment income is taxed. Let's start with capital gains, the profit you make from selling an asset like stocks or real estate. These gains are categorized into two types: short-term and long-term. Short-term capital gains refer to profits from assets held for less than a year, while long-term capital gains apply to assets held for more than a year. The difference between them lies in how they're taxed. Short-term gains are taxed at your ordinary income tax rate, which can range from 10 to 37% depending on your income. On the other hand, long-term gains enjoy a more favorable tax rate. These can be 0, 15, or 20%, again based on your income. Therefore, it often makes sense to hold on to assets for at least a year to benefit from the lower tax rate. Now, let's move on to dividends, the portion of a company's earnings distributed to shareholders. Dividends can be classified as either qualified or non-qualified. Qualified dividends, which meet certain criteria such as being paid by a U.S. company and held for a specific period, are taxed at the same rate as long-term capital gains. That's 0, 15, or 20%. Non-qualified dividends, on the other hand, are taxed as ordinary income. That means they could be subject to a higher tax rate, up to 37%. So, understanding the type of dividends you receive can play a significant role in your overall tax liability. In summary, the nature of your investment income, whether it's short-term or long-term capital gains, qualified or non-qualified dividends, can significantly impact how much tax you owe. The key takeaway here is to be aware of these different tax implications, as they can play a crucial role in your overall investment strategy. Now that we have a basic understanding of how taxes work, we can start discussing strategies. One of the simplest ways to maximize your investments is by utilizing tax-advantaged accounts. Let's dive into what that means. First up, we have retirement accounts. These are designed to encourage long-term saving, and they come with some excellent tax benefits. The two most common types are the 401(k) and the individual retirement account, or IRA. A 401(k) is an employer-sponsored retirement plan. You contribute pre-tax dollars, which reduces your taxable income for the year. Plus, many employers offer a match up to a certain percentage. That's free money, folks. The catch? You'll pay taxes when you withdraw the money in retirement. However, you'll likely be in a lower tax bracket by then, so you'll still come out ahead. An IRA works similarly, but it's not tied to an employer. You can contribute post-tax dollars to a traditional IRA and get a tax deduction, or you can opt for a Roth IRA and contribute post-tax dollars without a deduction. However, with a Roth IRA, you can withdraw the money tax-free in retirement. Now let's talk about health savings accounts, or HSAs. If you have a high-deductible health plan, you can contribute pre-tax dollars to an HSA. This money can be used for eligible healthcare expenses, and it rolls over year after year. Even better, once you hit the age of 65, you can withdraw the money for any reason, not just for healthcare. You'll pay taxes on it, sure, but any growth is tax-free. So, to sum it up, tax-advantaged accounts like 401(k)s, IRAs, and HSAs offer a way to save money now and in the future. They provide a means to either defer taxes until retirement or even avoid them altogether, depending on the account. The key is to understand the rules, make consistent contributions, and let the magic of compound interest do its work. With these accounts, you can either defer taxes until retirement or avoid them altogether. So why not start exploring these options today? The sooner you start, the more you can potentially save. Scene script. Next, let's talk about how choosing tax-efficient investment vehicles can make a big difference. When it comes to investing, we often focus on returns, but what about taxes? They can eat into your returns and impact your overall financial goals. That's where tax-efficient mutual funds come into play. These are funds designed with the aim to minimize the tax burden on investors. So, what exactly makes a mutual fund tax-efficient? Well, it's all about the fund's strategy and structure. Firstly, tax-efficient funds typically invest in stocks or sectors that offer lower dividend yields. Why? Because dividends are taxed when they're paid out. So, by keeping the dividend yield low, these funds aim to reduce the taxable income generated. Secondly, these funds adopt a buy and hold strategy. This means they're not frequently buying and selling stocks, which leads us to the concept of turnover. Turnover refers to how often a fund buys or sells its investments. A high turnover can lead to more capital gains, which are taxable. On the other hand, a lower turnover means fewer transactions and hence fewer taxable events. Therefore, tax-efficient funds aim to keep their turnover low. However, it's important to note that tax efficiency doesn't necessarily mean higher returns. A tax-efficient fund might have lower returns than a similar fund with a high turnover. It's all about balancing the potential for high returns with the potential tax implications. So, when selecting a mutual fund, consider its tax efficiency as part of your overall investment strategy. Look at the fund's turnover ratio and its dividend yield. And remember, it's not just about what you earn, but also about what you keep after taxes. By choosing tax-efficient funds, you can reduce the amount of taxes you'll owe on your investments. So, keep this in mind as you navigate the world of investing. It's not just about the big gains, but also about smart, tax-efficient strategies. Another strategy to consider is asset location. Now, when we say asset location, don't start picturing a treasure map with X marking the spot. It's all about where you're holding your investments, which can be just as important as what you're investing in. Let's take a moment to demystify this. Asset location is a tax-efficient investing strategy that involves placing certain types of investments in specific types of accounts to help reduce tax liability. The aim is to maximize your after-tax returns by strategically locating your assets in the most tax-efficient manner. So how does it work? Well, it's all about understanding the tax characteristics of your investments and the tax features of your accounts. For instance, investments that generate a lot of taxable income like bonds might be better off in tax-advantaged accounts like IRAs or 401(k)s. On the other hand, investments that are more tax-efficient like index funds or ETFs might be a better fit for taxable accounts. Remember, tax efficiency isn't just about what you invest in, it's also about where you invest. It's like a puzzle. Knowing where each piece fits can make a world of difference to the overall picture. By carefully choosing the location of your assets, you can make your investment portfolio work harder for you. Of course, everyone's financial situation is unique, and there's no one-size-fits-all solution. It's always a good idea to consult with a financial advisor or tax professional to help you navigate the complexities of tax-efficient investing and make informed decisions. You see, tax-efficient investing isn't just about avoiding taxes. It's about making smart, strategic decisions that can help you keep more of your hard-earned money and grow your wealth over time. So remember this, don't just focus on the rate of return. Consider how taxes will affect your investments and make strategic decisions about where to hold your assets. With smart asset location, you can further optimize your investments for tax efficiency. This strategy can be a vital tool in your toolbox as you strive to build a strong, tax-efficient investment portfolio. We've covered a lot today, so let's recap. We began with an introduction to tax-efficient investing, laying the groundwork for a deeper understanding of how to keep more of your hard-earned money in your pocket. Next, we delved into the basics of taxation, highlighting the importance of understanding how different types of income are taxed. This knowledge is key in forming a strategy that minimizes your tax liability. We then explored the power of tax-advantaged accounts. These special accounts, such as IRAs and 401(k)s, can provide significant tax benefits and are a crucial part of any tax-efficient investing strategy. We also discussed tax-efficient mutual funds, which can offer diversification while still keeping tax efficiency in mind. And finally, we touched on the role of smart asset location, emphasizing how the placement of investments in different types of accounts can affect your overall tax burden. Remember, tax-efficient investing is all about keeping more of your money, so why not start maximizing your investments today?